Welcome back everyone to the Audacious Money Witch channel where we talk about investing and trading stocks, bonds, and crypto assets around the world. Both Starbucks and Nike pays you dividend. Full disclosure, at the time of this recording, I do own shares in Nike stock. So when Nike falls, my wealth is affected slightly too. In this video, I will explain why Nike is falling because what Starbucks just said. Is it worth it to get in Nike stock right now just for dividend? Because you know it might take a while before the stock regains its momentum for the reasons I am about to share. I'll show you what Starbucks just said and why it's an ominous warning for the entire US economy. I'll show you why one sector of the economy says yes. Starbucks falls after warning that sales slump is getting worse, and this is something we shouldn't hear happening because after the Fed cuts interest rates by 50 basis points to 5%, what we have in Canada right now is Bank of Canada just cut another 50 basis points to 3.75%. Our money is again going to be worth less. Thank you so much. What happened is inflation went up. That is why I am going into Bitcoin, gold, and silver as inflation hedge. Non-farm payroll surged, and then mainstream economists, central bankers, all these experts from around the world came out and said that the Fed overdid it. There was not necessary that we are now achieving the mythical soft landing, and this was validated as stocks surged higher. Yet with Starbucks is warning the economy isn't getting better. In fact, it's about to get much worse. Starbucks reported a 7% decline. Same-store sales in the fourth quarter ended September 29th. The weakness was especially evident in the U.S., where transactions were down 10% from the prior year. And in China, where comparable sales fell 14%, and keep in mind, those numbers aren't inflation adjusted. And we know this is an issue that I've been worrying about because when incomes go down and prices stay high, consumers have no choice but to cut their discretionary spending. Starbucks now a victim of a slowing economy and warning that things are going to get much worse because we look at broad retail sales we talked about since 2022. They've been relatively flat, although slightly negative, but look at what you're seeing when you start to focus in on real retail sales. In the food services space, you see they're massively negative, and this has major implications. Because what this suggests Starbucks facing is an issue that's going to lead to store closures. It's going to lead to changes and layoffs, but what about the broad restaurant space? We're hearing a lot of restaurants struggling financially, not being able to get customers inside the door. And it makes perfect sense because when people have less money, the first thing they cut is eating out.
Starbucks' disappointing preliminary earnings reminded market of a harsh truth. Large-scale turnaround takes time. Nike investors would do well to take note. Tuesday afternoon, Starbucks released results for its fourth quarter roughly a week ahead of schedule. Their coffee shop chain profit and sales fell short of expectations and said it was suspended guidance throughout 2025 to give new CEO Brian Nicole ample opportunity to complete an assessment of the business and solidify key strategies. The real reason they suspended the guidance at this point is that they don't have answers, and that's the problem. If they were saying, hey, based on what we're seeing right now, things are going to get worse, they'll definitely send their stock price absolutely crashing and tumbling, and that's a no-no. Company will never want to do that, and what they were hoping is that They believe there is something they can do internally that is going to somehow turn around their whole business. The problem Starbucks is facing is the US economy. It's going in the wrong direction, and it's starting to accelerate to the downside in a major way.
A video of Nicole accompanied the release in which the newly minted CEO outlined a host of things the company needs to improve on. These included simplifying the coffee shop's overly complex menu, changing its marketing strategy, refining mobile orders, reformatting stores to look and feel like the community coffee house, and overall shifting the focus back to the actual coffee. While we remain optimistic that Starbucks can return to positive comps as fiscal 2025 progresses under Nicole's leadership, we suspect a reality check is needed on the timeline to reinvigorate profitability, which we suspect is a fiscal 2026 dynamic, and bullish analyst said. The fourth quarter sales decline was twice as steep as analysts had expected, and the biggest quarterly drop in 4 years. So we've talked about at what point is the US economy going to hit the deflection point where us consumers are finally tapped out. Well, my friends, based on what Starbucks is saying, is happening right now.
Starbucks said that a push to launch more products and offer a plethora of promotions failed to bring in more customers to the stores. So it's not an issue that we don't have the right products for you. That wasn't the problem. We're just getting a very clear view now of how cash-strapped US consumers are, and as we look across the restaurant space, what we can see is evidence that the US economy is facing the same problem as it did right before the 1970s, as we can see from the gold charts. That is a lesson Nike investors should keep in mind as they wait to see the results from the athletic wear company's turnaround effort, which will be spearheaded by the new CEO, Elliot Hill. An analyst at Jefferies sees Starbucks' pre-announcement as a proxy for Nike, illustrating that companies under pressure takes time to fix when a new CEO entered the scene.
As such, we expect the road ahead for Nike to be challenging and believe a turnaround will take longer than the market anticipates. Koenig from Jefferies said he reiterated a hold rating on Nike shares and an $85 price target. Like Starbucks, Nike has a laundry list of things to fix before sales notably improve. Koenig said, and the shift in market conditions over the past 10 years won't make things easier. Competition is heating up on all fronts, and consumers have become more discerning, meaning that Nike has to work hard to win back the customers it lost to companies like On Holding, Adidas, Lululemon, New Balance, and Hoka, he added. The first step is revamping the brand's product design, Koenig said. In the past few years, Nike has relied too much on 3 lifestyle models to drive growth: the Air Jordans, Dunks, and Air Force One, which has harmed the performance side of the business, particularly running.
Nike also has to fix its wholesale channel strategy. Under former CEO John Donahoe, the company accelerated its shifting away from selling shoes at retail partners, hoping it could sell directly to customers like Lululemon instead. That strategy backfired. Retailers filled up the empty shelves with Nike's competitors, exposing consumers to the brands that are eating up the company's market share. Investors betting that Hill will magically fix the wholesale channel problem, but that is unlikely, the analyst said.
The turnarounds, they take a lot of time. Plus, Elliott Hill has been dealt a very poor hand. When Nike reported a little over 2 weeks ago, it delivered a solid earnings beat, but it also had a revenue miss and weak guidance for the current quarter. They even pulled their forecast for the 2025 fiscal year, which ends in May. The stock got dinged in response and is still down more than 50% since it peaked in late 2021. Business is not good at Nike. So how can the new CEO turn the ship around? The company's already taken the first step by firing John Donahoe, a great tech executive who turned out to be a suboptimal shoe dog, the name real shoe people identify with. They replaced him with a homegrown Nike guy, someone who got his start there as a sales intern in 1988. Before his retirement in 2020, Hill served as president of consumer and marketplace for Nike. He really knows the core business back to front. The last guy always seemed clueless about what was going wrong. It was almost as if he thought that it was going right when it was going wrong.
Retailers are going to be conservative with inventory purchases and influenced by SKUs and brands that are selling through. Koenig wrote, as a result, we think Nike loses shares to hotter brands, creating ongoing pressure on Nike's wholesale orders, as Nike committed to providing quarterly guidance for the rest of the year. For the second quarter of fiscal 2025, it expects a revenue decline of 8 to 10%. The company also anticipates a 150 basis point drop in gross margin due to higher promotional activity, channel mix challenges, and supply chain inefficiencies. SG&A expenses are projected to remain flat year over year, with higher demand creation costs offset by reduced operating overhead.
Looking ahead, Nike expects revenue growth to slow, driven by weaker traffic on Nike Digital, softer retail sales trends across marketplace. Nike also expects year-over-year gross margin declines in the coming quarters due to ongoing challenges from promotions, channel mix, and supply chain pressures.
So is it worth it to get into Nike now for the dividend? As based on the fundamental and the technical analysis, we could go lower based on the revenue decline in recent quarters. It feels like Nike as a company is actually in decline. Yes, I know the brand moat is there. So you can make an argument that you can own it for the moat and the dividend money, but keep in mind, if the value of the company drops, even when Nike pays you dividend, your shares are still in the red as the stock drops slowly. So what I will do is to only buy when the stock hit the support, which I will share on this channel. Do yourself a favor and hit that subscribe button. So I wanted to share with you all today a very special lady that just became an author with me. I was coaching her for, over a year, I think it is now. And within a year, she became a writer, and this is her piece. I need to share it with you. And so I just want to show you really close up. So this is Caitlin Morrison, and it's Impending Doom. I'm so very proud of her. So this is a juicy story, and I hope you enjoy it. Let me know what you think in the comments below once you order a copy, and I will post the link. So it's Impending Doom by Caitlin Morrison, one of my clients, and she's actually on her second book. Congrats to the Coinbase gang. We are going to make it to all-time high. And thank you for watching till the end. I will see you in the next video.